Here's where we pivot now to the U.S. and what is happening within the U.S. structure. So what we always like to kick off with the summary slide, and this is the key driving components. So when you look at the current, the last week we had about 14.986 million barrels a day of demand. The week before that, we were about 14.069. So you can see just how low we are in comparison to even the reduced number of 2021. And we're well below the average when you're looking at 2020, when you're looking at 2017, 18, 19, and then 21. And we just don't see really crossing that 15 million barrel a day number. We expect to be between, but obviously the dailies can get close to 15 in general, but we see that average really not reaching that point because we don't believe that you're going to get a spike above where we were in July 4th. And you can see on 2021, we had a big spike as we got into Labor Day, and we just don't see that type of movement. Instead, we think it's going to be something that is going to be really below 15,000 barrels a day, 15 million barrels a day, which you can on average, which you can see is well below where we were for 2021. And that's on two different pieces. That's on the gasoline side, which is weaker than it was in 2021. But more importantly, diesel and trucking, which is way below where we were at the end of 2020 and at the really all of 2021, which is going to put that pressure on that market in general, which is why you see that average line, that white line's just kind of hanging well off of that level and closer to that 14.5 million barrel a day number. So now when we look at distillate is the one that is going to give us a lot of problems, but also refiners' problem, because you're going to see the shortage, but how do you hit it when you make diesel, you inherently make gasoline. So how again, managing this portfolio, this structure is going to be a bit difficult when you're a refiner, because that you're going to have to carry a weaker gasoline crack. But how do you do it? And again, looking at where diesel is, but diesel had a unseasonal draw of 780,000 barrels a day, 33.6 million below the 5-year. But more importantly, it's pad one. Pad one had a draw of 1.13 million, which is over 21 million below the 5-year. And the lowest it's been in 29 years. We have the chart for it. It is a big problem. And when you look at the 29-year average, we should be building into the end of September. And we're just not getting, we're still trending up, but when you look at the trend, it is well off of normal, and the rate of change has to accelerate. Otherwise, we're going to be in a big problem, which we think is likely as we head into heating season. Imports remain a bit elevated, just up 2,000 barrels a day. But as we've been saying, as the flow continues from Asia, from India, from the Middle East, there's going to be that competition into the Atlantic Basin between what can go into Europe and then what comes into the U.S. markets. So here, when you look at pad one, this gives you an idea of just how low we are, and we're flatlining. Like typically we should have, again, there's some periods where you have small draws, but the general trend is up. And you can see here the trend is sideways to slightly down, which is going to be a big problem, again, as we said, as we head into the winter months. While things in pad 3 are fairly flat. There's not a huge adjustment, but we need a lot of this to start flowing from pad 3 into pad 1. But you have the Colonial Pipeline that is crowded. You have what is the cost of Jones Act vessels, and again, those are the only two ways outside of obviously rail that you can get from pad 3 to pad 1. And with pad 2 remaining fairly low as well, there's a lot of competition in this region, and there's just not a whole lot either internally within the U.S. or externally to really fill that or provide that stopgap. All the while, distillate demand remains low, and this becomes a bigger problem when you look at on an economic basis. Because normally you obviously have your supply-demand economics. It's like, okay, well, if supply is low, then demand should fall to help kind of balance that out. But based on how low supply is, can demand really fall that far? And how much of that is elastic versus inelastic? And the other question is, do we have a choice? Like, is the market going to force demand that low? And if that happens, that does not spell good news for the economy, for the just general economic backdrop. We do, as we've been saying, we expect it to be above the lower end of the cloud, but well off of the 5-year average as distillate demand remains depressed. And here's where you continue to see that fall. It's just been a fairly straight drop. We don't see this adjusting. We should pause here, but how many times have we said that over the last 6 weeks and been wrong? So again, based on the data that we're seeing, you look at load availability coming lower again. And then you look at what we're going to show in a second, just what's coming to the coast remains lackluster in general in terms of imports. And that's going to keep us fairly depressed when you look at the shipping and trucking side. So now when we turn to rail, here you can see rail traffic, intermodal down 2.5%. It's just total carloads are slightly up versus 2021. Coal is going to remain robust. Farm products, corn, grains, all going to remain strong. And remember, 2021 was a massive year for grains, for farm products, and we're still either hanging in or higher than, so there's still a lot of movement happening in that area. Motor vehicle and parts remain strong. Even as you get cuts, there's been more layoffs at Ford. Toyota's talking about reducing output within Japan. So some of that is supply and demand driven just based on logistics and supply chain. But in general, you're just getting some of the slowdown, but there's still a backdrop between, if you will, what is on the lot and what has been scheduled. So there's still going to be some movement to fill that as intermodal continues to remain slightly off of 2021 levels, and we don't see that closing the gap, but holding here closer to about 3% below normal, below, I should say, last year. So then this is what we were talking about in general on the signal side. This is looking at what is coming into the West Coast. Here you can see that there is a big drop versus the previous week, the previous year. And we see it just remaining well below 10% or greater below where we were in 2021, which is still fairly elevated, but well off of where we've been. And the pressure's going into the downside, not the upside. When you look at what is coming on shore, we've discussed it on the Econ show, the bullwhip effect, how you overorder. New orders are dropping like a rock. Current orders are dropping like a rock. We're just not seeing the leading indicators showing a lot of growth, which is going to keep what we're importing remaining fairly low. All the while, heat waves continue. Last week, I did I think it was 27 cities, 4 states, 5 airports, seeing 12 out of the 22 hydroelectric assets we're looking to buy. And I can attest it was hot. The facilities were, if it was 100 degrees outside in the generating rooms, it was 170 degrees. So you're going to have a lot of consumption of natural gas. You're seeing thermal coal prices, run through the roof just because there's a lot of need for power gen. And again, that's another reason why we're confident in our purchases of these hydroelectric assets. But again, this is going to keep a bid underneath the natural gas side of things. Now, when you look at gasoline had a draw of 3.31 million. That's just 10.7 million below the 5-year average. But 2020 skews that. So if you take out 2020, we're actually very normal for this time of year. And then, but the only place that isn't normal remains Pad 1, down 11.9 million barrels versus the 5-year, and for the week was down 1.94 million, which is why we do expect to see a bit more of an increase from Europe into the U.S. But the ARB still remains fairly tight. It's not wide open where it's like, oh, this is a no-brainer. It's just based on it starting to open a bit more given the disconnect between futures and physical. Gulf of Mexico versus what's coming into the East Coast. Imports were down 266,000 barrels a day. We just expected getting closer to what is normal for this time of year, which is much closer to about 700,000 barrels a day coming into Pad 1. But there's going to be that timing delay. So again, you're just going to see this being fairly flat, while Pad 3 had a small build of 520,000 barrels, and that is actually over the 5-year average. Then that includes 2020. So again, you're just seeing the amount of builds that we've had in general. Gasoline, when you even with the 2020 in the numbers, you can see we're right at the 10-year average for what is in storage. And when you look at 2020 and you take that out, you can see how clustered we are, and we see this again, gasoline getting much closer. Not because there's going to be these massive builds, but it's just the comps get easier because we normally have draws as we get into the end of September, putting us in a normal position and putting downward pressure on gasoline cracks. Diesel cracks will remain robust. They're both going to come down, but gasoline is going to be that anchor, which is what we've been discussing when at the beginning of the year we said, look, distillate's going to be in a massive bullish spot, but eventually gasoline is going to be the anchor that's going to pull it down and be a huge overhang and a big weight on what kind of runs are we going to get, what kind of storage are we going to get, because we didn't expect gasoline demand to be very strong. So far, we've been right, and that's going, but we did expect diesel and distillate in general just because of what kind of crudes are available, what kind of flows do we have, where is it going, and we were starting from such a low point on the distillate front and fairly normal, if not slightly elevated globally on gasoline, that we're going to be put in this situation. So then when you look at global mobility, you can see here that the Americas continues to remain a bit weak. Europe continues to drop, which is, again, between Europe and the Americas, it's pulling the world average down. And then when you look at Asia Pacific and other areas, it's starting to come a bit lower. And then when you look forward in terms of Europe on the TomTom congestion, you can see a huge drop. We expect Europe to slow down even more. That's a mixture of just cost in terms of the pressure. They're already in a recession in Europe. So we again, this is also looking at price, but also, well, how are people feeling from a jobs perspective, spending perspective? And so just economically speaking, we expect to see, again, more pullback on that. When we look at gasoline and diesel averages, you can see that there's been a nice drop in gasoline coming back to about 430. That'll likely continue based on, as we talked about, the difference between where we are on spot, where we are on futures contracts. And it's likely to move closer to $4, which is still at the high end of where we were in 2008. Obviously, this isn't adjusted for inflation, but it's still something that's going to be painful. But when you look at the drop, diesel's obviously fallen, but not to the same degree in terms of where gasoline is. Diesel is sitting at about $5.36. Based on the slowdown in shipping and trucking, it'll continue to move a bit lower, but just not at the same rate that we've seen on the gasoline side. Now, when we look at blending components, I think it's important to say that blending, so gasoline storage was down 3.3 million barrels a day, but blending components was only down 1.34. So it's showing a much bigger drop or at least that slowing drawdown, which is why I think the gasoline move was a bit overstated on the storage side. And we're actually going to see this come back up because typically blending components is a bit of a leading indicator for where gasoline storage is going to be. So here you can see things are much, when you take out 2020, are very normal. It's either slightly above or right at the 5-year average. And that's where we think, again, gasoline is going to trend to on the storage side, which is going to put a bit more pressure on the market in general. And then when you look at demand, here you can see that we are still well below even the 10-year average, and that is factoring in 2020. So we're below the 10-year average. We're still well below the 5-year average, well below all of these levels. And as you can see, that peak, which was July 4th, which was the high for 2021. But normally you get that nice little spike at the first week of August and then again for Labor Day, and we just don't see the same type of spike that we're going to get. Instead, it's going to be at that lower end of the scale. And then when you look at activity, parks slowed down. Obviously, you had the peak for July 4th, and then things get back into what we'd like to call the summer normal. Workplace, transit remaining low. Retail, recreation, though, slowing down. That's, again, more of that pressure, which we continue to see as we've been saying that there's just not a lot of spending on travel, and it continues to fall at this point in time. So here when we look at propane and propylene, propane had a build of 2.59 million. That's still 7.2 million below the 5-year average. And as you can see, the rate of change slowed. So even though we're getting builds, we're setting new 5-year lows for where we are. And a lot of that is driven based on how robust the export market has been, with days of supply, again, remaining fairly stable, but we expect this to continue to move a bit lower. Jet fuel had a small build of 280,000 barrels, right in line, just 1.4 million below the 5-year. Here we had a nice little spike in demand. We expect this to come back down and much closer to about 5.6 at this point. It's not going to be a huge drop. But the reason why we say that is because when you look at passenger demand, as we've been driving this home, we're still well off of those 18 to 19 numbers. We're above where we were in 21, and that's just going to be the case here. We're going to sit pretty comfortably, but we're starting to crest, and that crest is going to come down because people go back to school and school starts to pick back up. And as that happens, that's when you see that natural drop down in activity as school picks back up and people travel a bit less. And you're starting to see it here with passenger flight schedules for the 12 weeks ahead is now 0.63% lower. Remember, it's usually between 0.1 to 0.10. Now it's down to 0.72%, 0.63%, and I think trending lower at this point in time. In terms of eating out, still strong. It's anywhere between 3 to 10% better. And just based on what we're seeing right now, we don't see that adjusting. People are still eating out. This is, again, key vacation points. Everyone likes to eat out during vacation, so here you are. And so far, we don't see that changing in the near term. So that's what we have for you on the U.S. in general. Now, in the next segment, we're going to go deeper on the broader market in terms of what's happening internationally, especially between gasoline and diesel.